Hello, everyone. Today I'd like to talk to you about the loan conditions and competitiveness of the ZANK Income Fund's development land loan product. So, first question, what is development land? Our definition of development land refers to a piece of land where, regardless of whether there are any existing structures, the current development value of the land far exceeds the value brought by any buildings on it. We consider properties of this type as development land. In the past 2 years, because of the continuous increase in interest rates, it has become challenging for banks to provide loans against this type of collateral. The main reason is that the value of this type of property is high, but the rental income and other passive income generated by the property are insufficient to cover the monthly interest payments. So, most development land loans in the market are provided by non-banking financial institutions. These types of non-banking financial institutions typically do not require borrowers to provide 100% servicing, but only requires the borrower to pay the interest for the entire loan period in advance. For example, if the interest rate is 10% and a lending institution approves a loan of $5 million, they would pre-deduct 1 year's interest. Therefore, the actual amount received would be $4.5 million. So, ZANK as a non-banking financial institution, what is the advantage in development land loans? Firstly, for development land loans in some mature areas, we can accept not withholding the interest for the entire loan term. Of course, for the developer, they need to prove that they have sufficient funds to pay our interest quarterly or monthly. For example, he can demonstrate that his bank account or other business can provide him with a stable cash flow. For some developers, it can greatly secure their upfront cash flow. They don't need to prepay the entire 1 to 2 years interest to us in one go. For example, if a borrower currently owns a shop that generates a rental income of over $200,000, and when they come to us for a loan, the annual interest they need to pay is $300,000. That means they only need to pay an additional $100,000 annually to cover our interest. That loan terms are much more flexible than traditional banks. The second advantage is that we can accept a short-term assessment method for regular residential properties. In the past 2 years, because of the continuous rise in construction materials, fewer and fewer developers are willing to purchase development land at this time. Even when purchasing development land, developers take into account the fact of rising construction materials. So, many lands bought in the past 3 to 5 years, if put on the market for sale now, are likely to be priced lower than before. The main reason for this is the increase in construction materials and labor costs. Developers are forced to continuously lower the price of land to maintain the same profit margin as before. We had a case before where the valuation of the development land was too low, even lower than its value as a residential property. In this situation, for traditional banks, they would still appraise the land as development land. As a result, the borrower would qualify for a much lower loan amount. However, we also understand that the undervaluation of development land is just a temporary situation. When the entire market returns to a normal state, the development value of a piece of land will undoubtedly surpass its residential value. So for this case, we can accept the current evaluation using the assessment method of a regular residential property. After 1 year, we will review this case again to see if its development value has increased. This also provides a short-term solution for developers in the current unique circumstances. The third advantage is that we offer a higher LVR. For development land loans, our LVR ranges from 55% to 65%. For properties located in areas with poor geographical accessibility or relatively unfavorable locations, we can offer a LVR of 50%. The main reasons we consider for the LVR are the population base in that area and the average sales cycle of similar types of properties in the market. If a property type has a short sales cycle in the local market, for example, around 45 days, then we can offer a relatively higher LVR. The fourth product advantage is that the application fees can be correspondingly reduced when refinancing. When our land loan is about to end, if the borrower wants to convert this land loan into a construction loan, the application fee for the land portion will be correspondingly reduced. This can also reduce unnecessary costs for borrowers when financing between different financial institutions, helping borrowers lower the overall cost. Our last advantage is self-approval and fast settlement. Our entire loan approval process, from application submission to settlement, can be completed in as little as 10 days. For borrowers who need urgent settlement, we will do our utmost to assist. Finally, thank you all for watching. If you have any questions or inquiries regarding commercial loans, please feel free to contact us. Thank you.